Just a little bit of a correction. When I actually started my journey as an investor, which is now about 28 years ago, I was actually a buyer of great growing businesses, because you always do the best if you can buy into a business that's going to grow intrinsic value significantly over time. Usually that's better than buying discounted dollar bills and such. But then as we got to 99, 2000, and this great dot-com bubble was brewing, I was probably able to see it not very much in advance, but maybe probably 2 or 3 months ahead of where everybody else was, or most people were. And thankfully, I was able to sidestep the bubble. Things went really well from 95 to 2000. I think I had $1 million, and it was up to about 13 million in that period. And then Pabrai Fund started in 99. And at that point, I actually switched 99, 2000. I switched to Graham Deep Value, because the interesting thing was on March 9th, 2000, which is the day the NASDAQ peaked at about 5,000, was the day that Berkshire Hathaway actually hit a multi-year low. So there were lots of undervalued assets in non-sexy businesses. And there was a lot of froth and euphoria in the whole tech and dot-com space. And of course, the NASDAQ over the next 3 years went down from 5,000 to about, I think, 1,200 or so, like a 75% decline. And I was buying funeral homes and steel companies and so on, and those did extremely well over that period. So in general, to answer your question, capitalism is brutal. In businesses are aberrations. So the nature of capitalism is such that if someone builds a better mousetrap, which, grows a company and generates high returns on equity and very profitable and so on, they have a target on their back. And in general, that will attract a lot more competitors to enter your space. And they'll try to chip away at whatever advantage is there. And mostly they will succeed. And moats are really more the exception to the rule. Let's say you have some small city in England and it has no Thai restaurant, for example. And someone looks at it and say, I think Thai restaurant do really well here. And they open a Thai restaurant and they do really well, and they're full all the time, and they can charge premiums versus London and other cities. That is going to attract more people and more entrepreneurs to open Thai restaurants, until eventually the economics of the Thai restaurants in that small city may be no different from other parts of England. Now, sometimes what happens in capitalism is we get aberrations. And when this pharmacist started the Coca-Cola company, he had no idea what he was onto. And no one could have imagined that Coke would end up being the brand it is today. And actually, quite frankly, there's nothing particularly magical about Coke, in the sense that they say they have the formula locked up in some bank vault in Atlanta. But it's really easy to clone Coke, and several companies have done that. And when Pepsi introduced the Pepsi Challenge in the 1980s, they basically gave people 2 colas to drink with no brands on them. And they said, tell us which one is better. And most people preferred Pepsi because it was a little sweeter. And then after they took the test, they would tell them, oh, by the way, you preferred Pepsi. But if they presented the 2 drinks to most people with the brands, Coke and Pepsi, most people would prefer to take Coke. And so Coke's moat is, if you look at it kind of objectively, really doesn't make any sense. They have a product that can be very easily cloned. They have competitors in many cases who have better products, but a brand got built. And a brand got built, and people have preferences, and they don't have a full lock-on monopoly, in the sense that when you go to the supermarket, if Pepsi is 20% cheaper, a lot of people will switch. So the brand loyalty is not that extreme in something like Coke. The same applies to Visa or MasterCard, American Express. If you just look at the different businesses that we see as having great moats, we can tell in hindsight that a business has a great moat. Now, even a business that has a great moat, the nature of capitalism is that moat is very likely eventually to get filled in. So if we go back in history and we look at businesses that have survived and thrived for a long time, very few businesses that are founded make it past their first year. A few will make it past their 5th year, and even fewer will make it past their 10th year, 20th year, 30th year. It just keeps going down. If we start looking at businesses that are more than 100 years old, for example, that we would recognize, like the Coca-Cola company, American Express and so on, Wells Fargo Bank and so on, it's a very small number. And if we go to, let's say, 200 years old, might get some liquor companies, few things here and there. The oldest business, the known oldest business on the planet is a very small boutique hotel in Japan, 30 odd rooms that has been running for about 700 years in the same family. I think it's like in the 35th generation or something. And they've survived world wars and they've survived all kinds of things. Japan's gone through a lot of change in 700 years. But basically, if you start looking at businesses that are 200 years old, 300 years old, 500 years old, you're not going to find very many. And you're not going to find very many that are even 50 years old. So if you look at a business today, let's say, for example, we'll take a look at a business like Apple today. Is Apple going to be with us in 10 years? I'd say that's a pretty good bet that, yeah, they'll be around in 10 years. Will they be around in 20 years? I think the odds are high that they'd be around in 20 years, but I don't know whether I could make a statement that the Apple of 20 years from now will be a more valuable company than the Apple of 2023. It very well may be, or it may not be. And then if we, let's say, ask the question 50 years from now or 100 years from now. So do we expect Apple to be a more valuable company 100 years from now? And if I were a betting man, which I'm known to be, I would take the other side of the argument and say that I don't think it's going to be more valuable. I was having a conversation with Charlie Munger a few weeks ago. And I told him, Charlie, the one thing that's going to survive in the Berkshire portfolio for more than 200 years is going to be the railroad. So Berkshire owns Burlington Northern Railway. Now, 200 years from now, the technology of rails may change. Maybe for freight, it might be maglev or something else. But the point is that they own the rights of way. And they own that land, and they own the connection to the ports and all of that. And humans need some way to transport goods in large land masses. So I think the Burlington Northern Railway is likely to be around and thriving 200 years from now. And then Charlie said to me, he says, I think our utilities will be there as well. They have a big business with a lot of power companies that Berkshire owns. And he's probably right about that. But he did not mention to me that Coke would be there, for example. And I think Coke will be there. I think that's a pretty decent shot. But they very well may not be. We don't know. 200 years is a long time. Look at the world 200 years back. So the difficulty with capitalism is that when we look at businesses that may look dominant today, our job as investors is to project what these businesses may look like 5, 10, 20 years from now. And that is a very difficult exercise because you have all these marauding intruders who want to take away your moat, who want to take away those profits, and they're continuously coming at you. That's what makes this a fun and exciting endeavor from my point of view, because trying to figure those things out is not that straightforward.